Hello guys, welcome to our YouTube channel. My name is Anthony Kimbati from AIB Axis Africa. So picture this, the Nairobi Securities Exchange is a 2 trillion market, right? If someone was to stop you on the street right now and ask you, what do you know about the stock market? What would you say? Think about it. Meanwhile, today we have an amazing guest on our channel. He's a seasoned investor in the markets, and at the same time, he has written several articles and several books on the same topic. So I'm so excited today to sit and talk with him. His book, How to Invest in the Stock Market, is a goldmine for anyone who wants to be profitable in the market. So let's sit with him and have a talk with him on all matters finance. Enjoy and join me as we do this. Okay, hello.
Hello.
So excited to meet you today.
Nice to meet you.
So let me start by asking, who is Mr. Peter Wambu and what led you to write the book?
Okay, Mr. Peter Wambu is just an ordinary guy who got bitten by the bug of investing in the stock market way back when I was still a student at the University of Nairobi. And I started off by joining an investment club of some former schoolmates who had come together to put funds together to invest together in the stock market. And from there on, I decided to go fully into it while still pursuing my course at the University of Nairobi. My background is actually in architecture, so I have no background in accounting or finance. So, and I always tell people, you do not need to have a background in finance or accounting to invest in the stock market. You just need to know the strategies that are there that have been proven to work, and make use of those strategies and invest and make some money in the stock market. I wrote this book with the idea that somebody who reads this book has never been in a stock market, and I wanted to see what kind of a structure can I come up with so that this person can start from the bottom and move up the ladder. And so even the book is structured in such a manner that you don't need to have done accounting or finance to understand the stock market. And I've taken you through the full breadth of a novice to somebody who can invest confidently in the stock market.
So you've said you started investing when you were young, right? So why should young people invest in the stock market and not in crypto, forex? Yet we're seeing there's a lot of volatility in crypto and forex.
First of all, young people need to invest in the stock market because they have a lot of time ahead of them, and they have time even to experiment and learn a lot. Not only that, they can also begin making money when they are still young, and hopefully retire also when they are young, and just have fun in life. Now, coming to why they should invest in the stock market, any investment that one goes into, there are a number of things that you look at, and one of them is the returns. And compared to other forms of assets, historically the returns in the stock market have been very, very good compared to other assets, and that is why I advocate for people to invest in the stock market. It's not that I'm not against cryptos or the forex market, but each type of investment has its own characteristics, and it depends on your personality and whether you have the time or the knowledge or the skills to do it. And young people can also diversify and also go into the forex market and the cryptocurrencies. But I also advocate that they should also be in stocks.
Okay, so when we talk about money, the first thing that comes to mind is profits. Is there a structure to profiting in the stock market? Is there a structure to profiting when investing in shares?
Yes, there is a structure to profiting in the stock market. I would like first of all to give a quote by somebody, a management thinker called Edward Deming. He said that if you cannot explain the process of doing something, then you do not understand it. So it is very important for you to know the process of investing in the stock market and the ingredients for success. Let me start by saying that the ingredients for success in the stock market is choosing the right stock, buying at the right price, and buying or selling at the right time. So 3 ingredients: the stock, the price, and the time. Those are the ingredients. And this has always been the challenge for somebody to choose the right stock, buy at the right price, and sell at the right time, or buy at the right time. Now, to understand the structure of profiting in the stock market, let me first of all explain my understanding of it. There's what I call the triangle of price influence. It's something that took me long to just think through it and come up with that triangle. And the 3 apexes are the business, the market, and you, the investor. Then around that triangle is the environment, and then price is at the center. So all these are the factors that influence price. So the business, whatever happens to the business has an effect on the price. Whatever happens in the market has an effect on price, and also your action as an investor, whether you're an individual investor or it's an institutional investor, whatever action they take in terms of buying and selling, it affects the price. And also, generally, the environment also affects the prices, because these businesses are in an environment that is constantly changing, and these changes have an effect on the businesses. And so, by extension, they also affect the price. However, it's important to note that price changes basically because of demand and supply. So all these others are actually reasons for demand and supply. It's very important to know that, because even a business can be performing well, but its price is not moving because there's no demand for its stock. So it's important to understand the fact that demand and supply is actually what causes the price of a stock to move up and down. And then the others are factors that influence demand and supply. That's something that took me time to understand. You see, because we are all different, and we have different beliefs about the stock market. So some people will believe more about the business side of influencing the stock market. Some people will believe more about the stock market, or rather the market itself influencing price. And others will be looking at factors of the environment influencing the price of the stocks. So depending on you, the person, there is what convinces you as the main factor influencing price of the stock market. And normally that is what you will follow. And each person who goes to the market has a certain belief. Whether that belief is true or not, each person goes with a belief to the market, because in the market, you actually sell your belief. It's your belief that you're trading with. And at the end of the day, what is important is whether your belief leads to profits. And now, depending on what you believe, let's say, for instance, that you believe more about the market, the demand and supply affecting price. So what you'll be monitoring are the demand and supply levels for you to take action in terms of buying or selling. If you are a guy who believes in the fundamentals of the business affecting price, then you'll be looking at the fundamental factors of the business and the value of the business, and that is what will inform your decisions to buy or to sell. Price also has an influence on itself. It's called a feedback loop, because there are people who are constantly looking at price, and they are just focused on price, and they see price moving up and down, and they react to that, and so maybe buy based on that. And in the process, they also influence the demand and supply, and in effect, they cause price changes. So whenever you're investing, you need to start off with a belief. And this belief will lead you to whether you are going concentrate on investment strategies or trading strategies, because generally there are about there are about three sides of investing in the stock market. Broadly speaking, you can talk of investing, you can talk of trading, or a hybrid, or you can talk of gambling, because also some people just gamble, and each of those styles has its own strategies. For instance, if you look at the investing strategy, you could be a value investor, you could be an income investor, or you could be a growth investor. If we are looking at the trading strategies, you could be trading on the various technical indicators. You could be looking at the trend, you could be looking at support and resistance levels, you could be looking at momentum of the stock. And as a hybrid investor, you could be combining those factors to improve your chances of getting things right. Because investment is all about high probability situations, and whatever can increase the probability of you winning, then you can rope it in. You can make it part of your arsenal for trading. And also, of course, don't forget that there are also people who just buy stocks for the sake of buying, or they buy just based on hot tips or recommendations from anyone, or they see the prices are going up and they just jump in without any idea exactly what even the company does or what the company is all about. And those are what I call the gamblers, And even in the stock market, you can rig the game by making sure that you only invest in high probability situations. So you do your research well, and you make sure that you understand the company that you're investing in well, because that is the first insurance not to make losses, by knowing the company you're investing in, and by researching it well, so that you know the factors that influence that business that company handles. Yes.
Okay, what are some of the money management strategies one can use to first reduce risk and then accelerate the gains?
Okay, first of all, money management is basically a way to apply brakes or apply gas. And in terms of applying brakes, is basically controlling a loss. And one of the key strategies of controlling loss is what is called the stop loss. Anytime you have invested, if the market behaves contrary to your expectations, then you don't just sit and wait. You can get out of the market with the aim of going back later when things improve. So cutting losses is one of the key strategies. And I've seen, because of this, a lot of people have lost money in the stock market because they just watched as a stock fell to its rock bottom without doing anything. They're just seated there and hoping that things will change and they can recoup the losses. But hope is not a strategy in investing. You cannot rely on hope. So I always say that if the market is not going according to expectation, you can cut loss, and you can determine at what point you want to cut your losses. I advocate for a figure of 10%. When your price has gone down by about 10%, don't let it go beyond that, because at 10%, you require just about 10% to get back to square one or to get back to even. But the moment it starts sliding beyond that, then it requires more effort to get back to even, and it will be a waste of time, and you'll be stressed a lot. So always make sure that you cut losses when things don't go according to expectations. But of course, if the fundamentals of the company are okay, and that maybe the company is just being beaten unfairly by the market, then you could hold on if you are sure about the fundamentals of the companies. But if the fundamentals are not okay, then get out and get back in later when things have improved. So don't let money fall through your pocket just like that as you watch. Seal the pocket, or take that money and move it to another pocket. All right. That's one of the strategies. The other strategy to control risk, of course, is diversify, because no one knows exactly which stock is going to rise and which one is going to fall. So you want to cast the net wider a bit, so that you can be able to choose that in case one falls and the other one goes up. Maybe then at least it can cancel out, or you might find generally your investment has moved up in value. If one of the stocks, for instance, has moved up substantially. But again, I also don't say diversification just for the sake of it. You should not diversify in quality. Make sure that when you are diversifying, you're not just doing it for the sake of it, but you are diversifying in quality stocks. You have analyzed the companies and you have seen that they are worth your investment. On the side of accelerating gains, of course, there is what you call compounding. Compound interest, as Albert Einstein said, is the eighth wonder of the world, and it helps you grow your money faster. And you can also do that in the stock market. As you buy and sell, then you keep putting back even the interest. You keep basically rolling the interest as you go on, and that way you're able to move to rise faster in terms of the value of your investments. Yes. The other thing that can also accelerate your gains is what I call stockpiling. If a company, the stock of a company is the price is falling, but you are sure that the fundamentals of the company are okay, then you can continue buying even as it goes down. As long as you are sure that the fundamentals are sound, you can do that. And because on average, then you'll end up having bought your stocks cheaper. And when the trend reverses, then you're bound to make a killing out of that. Yes, you're going to reap very, very good gains if that happens. If it turns back and starts shooting up.
Okay.
Yes.
Looking at all the things we've talked about, it's really clear that markets are really stressful. So, what's your take on the psychology of trading, and give the investors some insights on the psychology of trading?
Okay, stress only comes when you don't know what you are doing. But if you know what you are doing, then and you are very clear about your strategy, then it should not stress you. Because in the stock market, you are supposed to behave like a machine. A machine only acts according to what you have told it to do. A machine has no emotions like a human being. But a human being is prone to emotions. There is a constant battle in the mind between reason and emotion. And usually, emotion wins. And when you trade with emotions, then you are bound to lose. So I always tell people, you trade, you should invest like you are a machine. If your strategy says buy, you buy. If your strategy says sell, you sell, without question. But of course, you need to have tested your strategy to see that it produces the results over a period of time. You can do what is called back testing to see that strategy has actually produced results or could have produced good results, so you can be confident in terms of moving on with that strategy. Psychology is about human behavior, and emotions affect our behavior a lot. And there are three key emotions in the stock market that really mess around with people, and that is the emotion of fear, greed, and hope. Fear paralyzes you. When you allow fear to creep into you, then it stops you from investing if you have not invested, because you fear you might lose money, or it makes you get out of the market even at a time when you should not. Greed also also affects how we trade. Greed is this insatiable need to get more and more, and when price is rising, you lose sense that you lose the sense that actually the price can actually reverse at any point, and so you continue holding even after having attained some gains, instead of maybe selling, you just continue staying there even when the signals are red, and in the process you end up the price reverses and you end up losing. So greed also is something that I advocate people to try and control as much as possible. The other emotion I was saying is hope. See, like when price falls, people continue holding on, even when the warning signals are blaring, with the hope that the price will reverse. But you cannot use hope as a strategy. If prices are going down and the idea is that you should cut your losses. Now, I usually explain this with something I did with my friend. We bought a stock together at the same time, and we just wanted to experiment on this idea of cutting losses. And the stock kept moving up and down, and I strictly followed the aspect of cutting losses, and at the end of the day I had more gains. He just relied on hope, and in the end he lost. So I always tell people, hope, you should never rely on hope. Get out of the market if you need to, and because you can always when you have money, you can always go back into the market.
Yeah.
Yes.
When investing, we have both fundamental and technical analysis. So let's talk about the fundamentals. What are some of the factors when it comes to the fundamentals of a company we need to look at to decide this is a good company to invest in and this is a company we don't need to invest in?
Okay, one of the things I want to say right from the word go is that numbers don't lie. And if somebody just told you to choose a particular company and they are not giving you facts, all they are doing is giving you an opinion. Because and there are a number of factors that you can look at, or rather key key indicators that you can look at when deciding on the company to buy. And one of them is a return on invested capital. This is I treat this as the first one to look at, because in a business, their goal is to get returns, and if the returns are not good, then the business cannot justify its existence. So I would always advise people to look at the return on invested capital. That is, look at the profits against what the shareholders have given and what maybe the company has borrowed to put into the business. And if it's not above 10% consistently for a long period of time, personally, I don't invest in it. I want to see a company having considered for a number of years. I can even consider 10 years and look at it historically and see how it has been giving returns. And if it's above 10%, I'm okay with that company. I know because of this consistency, I can be able to use that as a springboard to project the future. Yes. The other key thing to look at, of course, is sales. That is where everything begins. If the returns come from the sales, if the sales figure is not increasing, then we have to. It's not a company that you really want to invest in. So you have to look at the numbers, the sales numbers, and again I also advocate that for above 10% as much as possible. So again, you historically look at the sales and the trajectory and how they have been growing, and if the sales are doing fine, they are increasing, and the rates are above 10%, that's a good company to invest in. If that thing is is the earnings per share. Of course, you go for companies that have a high earnings per share. If you're comparing between companies and stocks to choose, you go for the one that with a higher number, of course, because it means your shares are working harder in the company that has a higher EPS. The other thing, of course, you look at is the equity, whether the value of the company is growing over time, because the value also has an influence on the stock price. So if the value is growing, it's also going to grow the price of the stock. And so when you decide to take profit somewhere in the future, then it's bound to have gone up higher, and you're bound to reap high profits, you know. Then the other thing, of course, you look at is debt. Of course, the ideal situation is that you want a company that has no debt. If a company's debt is unmanageable, you know, it cannot be able to pay, for instance, its debt within a period of 3 years from its earnings, then that's a company you don't want to really invest in. But I'm not saying that debt is bad per se. Debt is good because every company requires sometimes to borrow some money to inject into its business to accelerate its growth. But debt only becomes an issue when it is unmanageable. So you must look at the debt ratios and see which company has the lowest ratios, and that's the company you would go for. So when you look at all those factors, you should be able to come up with, you should be able to see which company is better in all aspects, and you would go for that in terms of buying shares.
That was an amazing interview from Mr. Peter Wambu. So I want us to end with a parting shot from you, talk to the viewers, and basically tell them where they can get your book and give them your contacts.
Okay, I want to finish by saying that the stock market presents a very good opportunity for people to make money, and a lot of people have ignored the stock market, but now there's a growing number of people now who are heading in that direction because they have realized it is possible to make money in the stock market. But what I want to tell people is that you cannot just buy and sell shares anyhow. You must have a strategy to do it, and you must know what you are doing. You must know the process well, and I can guarantee you that if you do that, then you are going to realize gains in the stock market. Let me also say that I've explained that very well in my book, the process of doing that. And in my book, I've assumed that you do not know about the stock market. So you don't need to have even accounting or finance background to invest in the stock market. This book is available you can get it through Jumia. It's also available in Naivas supermarkets, and you can also get it from a number of vendors, selected vendors in Nairobi, and a lot of online book marketing sites. So grab yourself a copy and learn how to invest in the stock market, and let's meet on the other side when you're smiling from the gains. If you would like to reach me, you can reach me via email. My email is pewambu@gmail.com, or you can contact me through my mobile number, which is 0722 52 4394. Thank you.
So guys, that was Mr. Peter Wambu. Like, share, subscribe, and share your thoughts in the comment section below. At the same time, we have the AIB DigiTrader app, which makes investing super easy. Don't forget, you can buy shares using Bonga points. Finally, follow us on our social media pages at AIB Axis Africa. We're on Twitter, Facebook, and Instagram. Thank you so much, and see you around.